just a soft patch for sales in the first couple of months of the year. And of course, March's numbers have the potential to be affected by Iran and uncertainty.
Kia ora, and welcome to New Zealand Property Market Podcast, brought to you by Cotality for the 23rd of March 2026. I'm Head of Research, Nick Goodall, and today I'm joined as per usual with our Chief Economist, Kelvin Davidson. Kelvin, I think we've got plenty of economic data to digest later, in particular, of course, the GDP result for Q4, which was out last week. But first, let's take us through the release of our chart pack last week. I think there are a couple of things we often focus on here, our buyer classification series, first home buyers, what they're up to, as well as those sales volumes, which we put the chart in for that one too. So yeah, take it away, mate. What were those key outtakes and how'd the media release go?
Yeah, I guess so. Buyer classification, my favourite data set. Looking here at market shares, we'll come back to sales volume second. But in terms of market share, first home buyers still just trucking on. If you look month by month, quarter by quarter, even year by year, now it's been a pretty solid run of activity for first home buyers. So still taking 27-28% of activity. Just a really, really strong run from first-home buyers. The big thing, I guess, at the moment is definitely taking advantage of those low deposit lending allowances at the banks. That's a big way in for a lot of first-home buyers. So just same old story, really. They're really strong in the market. The mortgage multiple property owners sort of hanging around that 25% mark, 24%, pretty normal for them. So again, there's a bit of balance there. Some things supportive, some things a little bit more concerning for investors. Higher council rates, insurance, really, really soft rents. So there's supports for them, but also challenges. And I guess the other big group we look at is movers, or the relocating owner-occupiers. A bit of seasonal variability in those numbers. They dip back a bit in February after a reasonably strong January, but sort of trucking along again. So the same old stories that have been in place for buyer classification, I guess, for a while are still sort of there. I'm still keeping an eye on movers. I think there's scope there for them to come back to the market this year as and when the economy recovers. And yep, there's a bit more uncertainty about that now. But if we do see that slow economic upturn this year, then movers should get a bit more confidence to relocate, and I think we'll start to see them taking a bigger share of the market. But right now, they're still a bit quieter than normal. Those first home buyers are really active, and I suppose you'd call mortgaged investors sort of somewhere in the middle. So that's kind of the percentage shares. Now, in terms of number of deals, the overall market activity levels, they have been trending higher for 3 years now, really. Just a wee bit of sluggishness, I guess you'd say, in January and February when you look at the sales compared back to the same month last year. January was down 8% and February was down 7%. Now, they're not big collapses, and there's a sense there might be a timing issue in here. It looks like December was pretty strong, so maybe some deals were pulled forward if they could be. People sort of rushed through. But, there's a limit to how much that can really explain February's number. Could you really rush through deals that might have otherwise happened in February? Can you really rush that through into December? It seems a bit hard to believe. So, it's not necessarily the start of a new downwards trend either, but yeah, just a soft patch for sales in the first couple of months of the year. This is across private deals and estate agents, so it's across that whole market. So just a wee bit of sluggishness in there. And of course, March's numbers have the potential to be affected by Iran and uncertainty, and consumers sort of pedaling back a little bit. Cost of living, I know we won't trade that house because inflation's going to be an issue. So March's numbers could well be a bit soft as well. So this whole idea that sales will continue to trend higher, I think they probably will. We've got lowish mortgage rates. We've got a slowly recovering economy. Those things would push property sales higher, but maybe that upwards trend isn't as clear cut as it might have been going back to tail end of last year. So it's definitely one to watch, and I guess all economic and property market indicators at the moment are prone to a bit of variability, and we're operating in this environment, I guess, at the moment where lots of data series are available up to January, up to February, but we all know that March onwards is going to look pretty different, and we don't really get a lot of those March indicators for another couple of weeks, really, in terms of those flagship data sets. We've got real-time indicators, wholesale interest rates, and share market changes and that sort of thing. Obviously, oil prices, every sort of 1 minute we're getting updates on that. But yeah, those sort of monthly rolling series of economic and property market indicators, we're still just waiting for a little bit. So yeah, that's going to be interesting to watch. I guess that's going to be the big issue in the data for over the next 4 to 6 weeks, just seeing how that's starting to roll through. But yeah, general in terms of property market activity, it's been a sluggish start to the year, but within that environment, first home buyers still doing really well. So probably the main message.
Yeah, no, definitely. And I think, yeah, I'm sort of leaning the same as you in terms of, how much can you attribute February's weaker sales to December's strength? But I think there's probably something in it. The only thing that's sort of making me probably take pause a bit more with that was I saw your chart that you put together for your internal sort of weekly update to Cotality staff, and that chart of like annual change of sales volumes, and you can just see it trending downwards. So yes, it's still positive most months. I know the last couple weren't, but you can just see it slowing down. So it does look like it's kind of, maybe we can actually call this a bit of fatigue. Like we've seen increasing sales volumes. They're still going up generally, especially on an annual basis, but maybe it is going to sort of reach a bit of a crescendo at some stage soon. I also wonder, that our forecast for sales volumes, we sort of had, volumes going from 91,000 last year to around about 100,000 this year, but that forecast is obviously based on forecasts from the Reserve Bank around GDP and migration and interest rates and inflation and stuff like that, all of which are now a little bit old too. So I suspect once we get updated versions of those, it's going to dial back those sales volume forecasts. So I do wonder if, seeing sales volumes at 100K might be a little bit optimistic at this stage, and it will come dialed back a bit if we don't see that economic growth this year that we expected. So yeah, I'm starting to lean more towards saying actually this slowdown's a bit more real. We've seen it sort of take hold in Tauranga first. Now there's signs of Wellington, on a more consistent basis, tracking sideways year on year. So I just wonder if actually maybe we're going to get to maybe it's only going to be 91 to 95,000 sales this year. So that growth is going to dial back more than we originally thought. Just when you see that longer term trend of that sales volume growth slowing down. So I'm sort of leaning more towards that at the moment. And as you say, the problem is going to be, even once we get March sales volumes, you're not going to know how much of it's, just affected by general volatility, how much of it's going to be sustained due to that conflict, and how much that's going to affect sentiment in the market and deals being done. So yeah, who really knows? But that's the hard thing right now, is that yeah, the good data takes a while to come through. Some of the more immediate measures are really useful, and we'll talk about some of those shortly from an economic perspective. But because they're not tier one statistics, they don't get as much as much weight put into them anyway. But yes, I think that's where I'm leaning on the sales transactions. The other thing on the buyer classification data I wanted to touch on was the fact that I did do a little bit more work to understand those movers and their behavior. As you said, we've sort of focused on them quite a bit, and we've talked about the fact that, yeah, I suppose there's a bit of a circle here. When the economic recovery comes in, they'll come back and they'll help the economic recovery, but they'll also see the property market likely start to spin its wheels a bit faster and see the broader market have some upward pressure on prices. And that sort of is backed up by some work I just did, just looking at, like, if you compare what people pay compared to the RV, CV, GV, whatever you want to call it, only because that's a consistent measure. We could do it compared to our AVM, automated valuation model, or eValuer, of course. But if you do that CV, it's only relevant for a location itself because those CVs are all done at one date. All I do is then look at how that compares in that area, in this case in Auckland, and see if there's a different sort of premium paid between that sale price and that CV for different buyer groups. And generally, movers are paying more recently about 2% more than what a first home buyer is. And I think it makes sense. They've got the buying power. If they are active in that market, they'll probably get a bit more room to move upwards. And so they're willing to do that once they're active, or once they actually are determined to buy a property. And so that also just feeds into that thinking, right? That once these movers come back out from not being as active in the last few years, that it will likely see some more upward pressure on prices too. So, importantly, as you mentioned, this economic recovery and maybe these movers coming back is now going to be stalled or delayed a little bit anyway. But I think it does point to some evidence that says, yeah, once that part of the market gets moving, which is that middle to upper tier, people moving to their second or their next property from their previous one, they will drive a bit of upward pressure in that market, a bit more competition, and obviously, frees up a property for maybe a new time entrant to come into as well and provides that opportunity for those guys to enter. So that was another one that I just had a look at recently, which I think is worth touching on. But yeah, again, the relevancy might be pushed back a bit further because that economic recovery is not going to be quite as soon as we expected. So yeah, but I will leave a link to the full chart pack anyway. There's way more than those things we cover. It's a good recap of everything. Worthwhile. Download that thing, chuck it into your local, your favorite AI tool as well, and use it to ask any questions of and get your take on that as well. And there's a bit of regional things as well, particularly for those in the main centres. So yeah, do go and read the article on that one, download that report, and keep that one on file. And we'll continue to track all that stuff regularly, and it'll be a core part of our commentary as well. But anything else on the chart pack or the release the media focused on before we move on to our macroeconomic release this week, Kelvin?
I think that's it. Yeah, I can hardly remember yesterday, let alone last week. I think the media response was okay. I mean, any sort of media reaction at the moment's going to depend on what else is going on at the time with oil prices and things. But it always goes down pretty well. People like a good set of charts. So it's one of our more popular ones.
Yeah, absolutely. Yeah, no, cool. Well, then let's look at the economic data, particularly the Q4 GDP result, which was out last week. And noting it's a pretty big lag since Q4 finished. But ultimately, the headline here was that it was weaker than expected. So still positive at 0.2% growth in the quarter. But weaker than most forecasts had expected for that quarter. And we've got to acknowledge this as well before any uncertainty or volatility come around from global conflict happening now in Iran too. You've sort of hypothesized, I suppose, that you could maybe see this as a good thing, still some growth, but not as strong. And so there's still obviously required support for the economy, which for anyone in the housing market can be seen as a good thing. Do you want to talk us through that? And I think ultimately get us to a position where, how do you think the Reserve Bank will read this? One of the things I've been noting more recently or coming up is that both the Governor, Anna Bremen, and the Chief Economist, Paul Conway from the Reserve Bank are speaking tomorrow at an event. It's the first time we will have heard from them officially since the conflict in Iran. So I'll be watching and paying quite close attention to those speeches and see how much they acknowledge that and how they're going to read on that one. But prior to that obviously happening, we need to get our position on it and what we think they're going to say. So tell us about the sort of economic release, your read on it, how you think Reserve Bank will respond to it, and some of the key things that you're focusing on as to how they might make their decisions based on that result itself and some of the more recent releases that have come out in the economy as well.
Yeah. So, 0.2%, pretty, undershot. The range of expectations in advance was quite wide. So, but generally it undershot some expectations. I think the RBNZ, for example, had 0.5%. So, generally on the lower side. There are some quirks with the numbers. I don't fully understand it, but there's technical reasons why this might not genuinely be the number. The actual result could end up being a little bit higher because of sort of weightings of different sectors, and they're always rebasing these things through time. So revisions can be made, and so 0.2 might just be a little bit softer than the real economy, the actual result. So we could see that revised up in due course, but either way, still a little bit disappointing, I guess. I mean, farming was a strong contributor. Construction went backwards again. So, there is that variability. It's not like everything's weak. There are some sectors of the economy doing okay, but generally added up to 0.2% growth, which was a little bit sort of understated, a little bit disappointing. Do we worry too much about it? Not really, because it's always a bit outdated, and of course even more outdated now given what's been going on. I mean, we're not going to know. I was thinking about it earlier that we'll get the Q1 GDP numbers in the middle of June, but even that's going to have January and February in it, which was unaffected by the Iran conflict. So even those Q1 numbers will only have March in it. So, even those numbers aren't going to be a true reflection of kind of what's been going on. We'll have to wait till September to get the Q2 numbers, and who knows it. Hopefully it's all over in a few weeks' time. So, this might it might be hard to really get a true picture of all of this in the data, and we might not know for a long time anyway. So that's kind of a wee bit of a bit of intrigue, or a little bit of a tricky one around all of this. But I mean, in terms of the bad news is good scenario, I guess, for people, that's only really thing in relation to people with debt and worried about higher interest rates, is that because actual activity didn't rise as much as what people might have been anticipating, it implies that there's still spare capacity out there. This actual growth hasn't really absorbed any of that spare capacity, so people are still operating below where they could be. That's a sort of downwards influence on inflation, therefore suggesting the Reserve Bank, still has a bit of scope to leave interest rates where they are. They don't necessarily need to be rushing to push the OCR up because they've always said all along, we think there's a decent degree of spare capacity. It's probably still there because the economy itself hasn't really been growing that much. So, argues for flatter official cash rate, flatter mortgage rates. Yes, there's other influences on mortgage rates. What's going on in global markets? That's I think seen a couple of banks at least raise their mortgage rates in the past couple of days. But yeah, if you want to take if you've got debt and you want to take a positive view of this, the positive view is that it argues for lower for longer interest rates. So I think, do we pay too much attention to GDP numbers? Probably not. It's kind of old news. But there is that sort of silver lining in there for people who want interest rates to stay low. In terms of what the Reserve Bank does, well, yeah, we'll see what comes out over the next couple of days. Like I say, they've been pretty clear all along. They think the spare productive capacity out there, so not necessarily going to be in any rush to raise the official cash rate. And of course, there's nothing they can do about higher oil prices and higher imported petrol prices and all of that anyway. So, those sort of so-called first round inflation effects, what we're all paying now at the petrol station, that's something they simply can't do anything about. So that fact, as well as the spare capacity I think is out there, I guess for me just means you would hope for now a sort of, we're not losing sight of inflation for sure. We're still worried about it, but we don't necessarily think there's a need to rush either. You would hope that's the sort of communication message that came through. And actually that was sort of the message at the last monetary policy statement, even before this whole thing kicked off. They acknowledged, we're probably going to have to raise the official cash rate at some point, but we're not going to do it yet. So, maybe that line sticks around. A lot more uncertainty around that now, of course, but you think underlying it all is hopefully that message. So, it's kind of where I sit.
Yeah, it's really interesting, right? And I think every time we're going to talk about this, it's all going to come down to how long this conflict goes on. And unfortunately, over the last week, it's like every day it feels like it's going to go longer than we thought the day before. So that's obviously not good. Does that mean, do you think, that there's more chance that the broader inflation impacts of higher oil prices are going to flow through to other parts of the economy? Or do we still sit in this position where, because we're paying more into those things that are affected by higher oil prices, so there's less in other areas, which is going to reduce inflation of those things, and obviously the economy, as you talked about, with it being weaker, there's downward pressure on that. How do you sort of balance those two things up? I'm pretty sure it's the same conversation we had last week, and you sort of took more in our conversations about these second round impacts of inflation as well. What do we mean by that? How is that likely to play out? How are we going to know when we're in this position? Like, how do we know, how, if the Reserve Bank now are trying to control inflation in the medium term, and let's say that's 6 to 9 months away, how do we know what's going to be happening in 6 to 9 months? And I know it's dependent on the length of the conflict, but talk us through the potential for that.
Yeah, in lieu of having a big sort of massive spreadsheet model of the economy and how all these things interact and what the weightings are, I'm kind of, I've got a spreadsheet in my head that's kind of a bit of a gut feel. There's a few things going on in there. The second round inflation effects, people might start to hear that mentioned. It's all about, it's not just that straight up immediate, hey, price at the petrol station went up. That's sort of direct first round impacts. That's what the Reserve Bank can't control. They're not necessarily worried about. They're going to be worried about it, but only to the extent that flows through to lasting so-called second round effects, which is where a trucking company to get goods around the country, they're paying more for fuel as well, so they're going to have to raise their selling prices. That feeds into input costs for somebody else. A supermarket has to charge more because it's costing them more to get the goods in. Farmers, diesel prices going up for that production. Farmers are largely price takers, I guess. They can't really set prices, but still across the economy, that second round impact is the the wider, that flow through from higher fuel prices, what that does to costs of production, and then how that feeds through to kind of more lasting inflation. Manufacturers, they use energy as well, so their costs are going up. They're going to have to pass that on if they can. I mean, in a sluggish economy, there's a limit to how much price rises can be passed through, but all these things get really circular in this interaction thing. So yeah, the second round impacts are all it's that flow through to the wider economy, wider production costs, how that comes through to inflation, and I guess also how it impacts inflation expectations. If people are thinking, gee, this thing's going to last for a while, petrol prices are going to be higher for a while, diesel costs are going to be higher for a while, I'm going to have to actually pass this through. I can't absorb it. I'm going to have to pass it on. So, the inflation kind of becomes a bit more embedded, and that's where the Reserve Bank will get more concerned about it if it's passing through to what people are expecting as well, because that plays a role in what the Reserve Bank does. So, but yeah, at the same time, if things are costing more, if you're paying more for your petrol, if firms are paying more for petrol, diesel, all of this, there's less discretionary money available for other things. I mean, households are going to have to pay more at the petrol station. There's less to spend at the grocery shop or wherever at the restaurant. So, the overall spending takes a hit from that. So there is circularity here, and this is what will go into the big Treasury models and the Reserve Bank models. I've just got one in my head, which I'm kind of sort of weighing all this up. But so it's definitely not clear cut. But I think for me, there's the big uncertainty about how long it all lasts. But I guess I just probably worry more about the wider economic impact. It's the real economy. If people are having to pay more for petrol, if this is crimping business spending, business activity, then eventually there's going to be a downwards economic impact here, and especially global uncertainty as well. I mean, we just talked about the GDP numbers. It was pretty much held up by agriculture. If we can't export as much, if shipping's disrupted, all of that stuff, that's going to hurt the economy for sure. And with the spare capacity that already exists, that will hopefully hold inflation a bit lower than it otherwise might have been. But then that weakening economy would bring down inflation as well. So I tend to lean more towards the side of sort of being cautious about the economy, and that should sort of keep some sort of level of reassurance at the Reserve Bank in terms of how much they really need to react with higher interest rates. But they've only got one target, and that is the inflation rate. And so, almost whatever the economy is doing, they've got the target of inflation. And if inflation's going up, it gets a wee bit awkward. So I'm conscious of that sort of trade-off as well, and that conflict there between weighing up the balance of higher inflation versus the weakening economy. So yeah, that's what other people have to weigh up, I guess, when they make these decisions. But for me, in the back of my mind, I just think this can't be good for the economy. Yes, there's an inflation impact in the near term, maybe the medium term, but ultimately this is a negative story for the economy. So that should eventually bring inflation back down. And the thing I guess that's been maybe missing, if you want to put it that way, on the housing market has probably been a confidence factor, a sort of job security factor. Maybe that's starting to come back, but then boom, along comes this Iran thing, and that confidence factor is surely going to go missing again. So and that's going to be across the property market and the economy too. So I think that's probably the thing in my mind mostly, but we're definitely going to have an inflation impact, and if it feeds through to those second round effects and it feeds through to inflation expectations, then the Reserve Bank will definitely have to do something at that point. So we're maybe not there yet, but there's a lot to watch.
Yeah, there is, and that's why I think it's so intriguing at the moment, right? And I just wonder, as you say, yes, they're not trying to control the GDP or the economic growth necessarily, but they know that what economic growth is doing today, or expectations for economic growth at the moment or tomorrow or next quarter and the quarter after that, like you said, that has an influence on where inflation goes. And that's why it's so important, right? Even though they're not trying to go, oh, we need to speed up the economy. So actually what the economy is doing is going to have an influence on inflation in 6, 9, 12 months, whatever it is. And that's why it's so intertwined. And that's why I think, you get strong debates on this. We could probably talk forever about it, because there's no one read on this. And that's why I always say we can say what we suggest they should do or whatever as much as we want. It's really about what we think they will do, how we've learned from their style or their expectations and how they speak as to then what they're going to actually decide to do as well, which is why, as I say, I think they speak tomorrow. We'll certainly pay close attention to that. I think from an oil perspective, we haven't really heard from the government. I think they're pretty close to agreeing what sort of support they're going to provide for petrol prices, probably in particular. It doesn't sound like it'll be very broad, but that's okay. But once we know more about that too, that'll give us a feel for, how much true inflation people will be feeling on this as well, and how much it'll be across the board or for certain sectors or for certain, if it's in business or if it's just at the lower income or whatever, maybe more targeted. We haven't really heard from that too. So that's going to have an influence, I think, on a broader perspective. So yeah, that's why I think it's so interesting at the moment. The other thing I just want to touch on really briefly was we did have a couple of other, those faster moving economic releases. We had the Performance of Services Index, which is obviously a pretty important one for February, came out last week. That wasn't really good, but then the retail card spending data was better. Selected price indices data, which I think makes 45% of the basket, that came through too, showed higher inflation than expected in February. So look, I don't want to go into too greater detail here, but I think ultimately, again, all this does is reinforce what we're talking about, which is we've got a stuttering economy. It still hadn't even taken off, really before all this conflict happened. It's going to have downward pressure on the broader economy. And so, we're in a pretty precarious position from an economic perspective. And as you said, that means probably some downward pressure on inflation over the longer term. But also, we're in a heightened inflation position too, because it is higher than we thought. All the other things that we're measuring, and that's like food prices and those insurances and all the other things are proving more sticky and longer lasting than we expected. And so those are holding up more. And maybe that means the Reserve Bank does need to do more to reduce the inflation of those things, because if they're paying higher inflation for all those things on top of petrol, that is not a good situation, and they need to control that domestic inflation as well. So yeah, it does put them in particular in a pretty sticky spot. There's the term stagflation's come back again. That we're going to see a stagnant economy with inflation continuing to grow, which is the worst position for us to be in from a Reserve Bank perspective. So yeah, tricky spot. We'll wait and see what they say. I don't know, is there anything else you want to add on that lasting conversation around the economy, Kelvin? And then I just want to talk about a few other news or comment that we had as well, and wrap up for today.
Yeah, just so we comment about the property market. I mean, part of that selected price indexes releases rents, and so just to note there, the property rents remain really weak. The stock measure that Stats New Zealand publishes, which is across all existing tenancies, a sort of slower moving measure, but it was only up by 0.9% over the past year. That's the lowest annual change in the stock measure of rents for at least, I think it was going back 18, 19 years. That was as far back as I could see in the series. So, property rents just really, really weak at the moment. Great for tenants, I guess. Not so good for landlords. There's always that two sides. But yeah, so there's not much inflation coming from the property market anyway. Whether you look at rents, house building costs, property prices themselves, it's all pretty soft. And yeah, just to reiterate your comment about the Reserve Bank there, this is their absolute worst case position to be in. You've got a sluggish economy that's not really showing much growth. You've got inflation going up in the meantime, driven by things initially that they can't control anyway. What do? So yeah, that communication is going to be really interesting over the next couple of days. You'd hope they sort of stick to the line and just say, look, we're just monitoring. We're not going to have any knee-jerk reactions, but yeah, the big question is how long it goes for, and that they can't keep that line forever. So it's going to be interesting to watch.
Exactly. Yeah. How much can they quell the market, right? Because I've seen today that I think you mentioned it earlier as well, that those 2-year swap rates and other swap rates have gone up. And so the banks are pricing in those increases to the OCR sooner rather than later. Can they force those back down again? I don't know, from a speech or otherwise. Or, will they not be able to do much until they republish forecasts in May? And, if they are a lot more different to the rest of the economists and the market's pricing, then maybe that can have an impact. But otherwise, yeah, it's hard not to see, those interest rates continuing to grow. Forecast of the official cash rate to rise sooner rather than later. I'm not saying it's going to happen in April or in May, but certainly it's bringing that forward from maybe not just November, but further forward. But again, so much to balance up there with the economy as well. So we'll wait and see on that one. Certainly, yeah, pay attention to that tomorrow afternoon, and I'm sure it'll be covered next week's podcast. I do have to mention that I won't be in the podcast next week. I've been called up for jury duty, so I know you're going to call in our chief economist from Australia, who's pretty good in the global impact side of things too. So I'm sure we'll have a great chat on everything about that and some of the local things too. So I can look forward to that one, and you can break down that speech next week. But otherwise, March, I want to acknowledge that this week we do have our mapping the market data updated. If you go to the website right now, actually the data is already up to date, but we've got an article going to media tomorrow for Wednesday, so keep an eye out for that one. Did want to also acknowledge we got a comment on last week's podcast when we we're talking about affordability from Carl Horn. I just want to read it out. I think you guys need to stop looking at averages and do some case studies using actual people. I think when you use that model and look at wealth distribution in New Zealand, you will have a very different result. And I just wanted to acknowledge that question. I think it's a really good point, obviously. I think we try and do our best to acknowledge that, we have to use measures such as medians and averages when looking at these types of things around affordability, because there's no other way of doing it when you're trying to create a measure. And we've got 4 measures of affordability. But the main thing we're looking at is relativity over time and relativity between different regions to see what areas might be more attractive from an affordability perspective. Absolutely acknowledge that, the data, when it's an average or a median, doesn't tell the full story. And I think that's why we do try and put a real term context on it. We are out there talking to people, getting those real stories, understanding what's happening at the front line as well to try and add to that conversation. Because I think, there's sometimes the media do too much focus on case studies and they're not real, or they're real, but they're not representative. And then the data itself obviously needs to be, added to with some case studies and some real life impacts as well. So I think, we try to do that coverage. I thought you did a good job last week to talk about that relativity, that yes, things are more affordable than they have been the last few years. Not the best they've ever been, but back to long-term averages. It's better than it has been last few years, but that's not to say things are affordable or that they're easy right now. Whether you're trying to save for a deposit, whether you're trying to secure that mortgage from the bank, it's still pretty difficult, but it's certainly more easy now than it has been the last couple of years. And I hope we do a good job at trying to present that. But thanks to Carl for obviously pointing that out. And I totally agree that, we need to look at it from a more broad perspective, add those anecdotal ones on top of the real data, and then we present that full story based on all that information too. So once again, thanks for the comment, and again, you can either text us or you can comment directly on the platform you're listening through. We catch all of those, so appreciate getting in touch. Anything else on that, or anything else among the broad economy or market that you want to chat about, Kelvin?
No, I think that's it. Or plenty to watch.
Yeah, exactly. Yeah, I mean, like I say, often it keeps us in a job, mate. Any uncertainties or whatever, and helping us to, try and find something else to try and digest and then tell that story and hopefully bring it to market in terms that people can understand and help them to make a different or smarter decision off the back of that. That's what we're here to try and do. But that will wrap us up for our property economic discussion today. If that is all you're here for, then all those links that I've spoken about are in the show notes below. And Kelvin and Jared will catch you next Monday. But before we do head off, Kelvin, as per usual, keen to get your highlight of your weekend from, I don't know, sporting, personal. How's the weather down there, mate? How'd you get on?
Yeah, sounds a bit cliched or a bit dull or whatever, but probably the weather was the highlight. Actually, I don't want to make it a weather podcast, but just I don't know, nice autumn weather. You can just do a few things. My daughter had cricket. I played a bit of golf Sunday afternoon, and not saying family time is always easy, but there's definitely ups and downs. But everyone was pretty good in the weekend. It was just a nice sort of relaxed weekend, which I think is aided by just warm autumn days. So. No, it was good. I feel pretty good about that, and I mean, the Wars sporting. You'd probably have to say that's the big thing on the New Zealand sporting front at the moment, top of the table. I wish it was the Raiders, but if it can't be the Raiders, we'll go for the Wars as my second team. So things are good. Feeling positive.
They're only 3 weeks in, so I think everyone just needs to calm down. But you have no doubt some good results from the squad. Yeah. 38 and then or more points in all 3 games. So signs are good, no doubt. But look, like I say, the sun just brings out the smiles, right? And kids seem to be happier. And look, that's probably my highlight too, was beautiful weather here. I can blame you now for bringing it up because otherwise it's just a typical Wellingtonian basking in the glory of the few days that we get in the sun. But we had great weather over the whole weekend too. And we had my wife's mum came up and looked after the kids. we had this event on Saturday afternoon called an urban cocktail trail. So that was really cool. You know, like you bought an event ticket, it got you 6 cocktails, you sort of moved between different bars throughout the day. We seemed to be following the sun throughout the whole afternoon. You got a discount on some lunch as well at some stage. So yeah, and sort of stuck around for the evening too with some friends. So yeah, had a great old afternoon, and yeah, as I say, nice to avoid the family parenting job in the evening as well. So didn't get home until after the kids were in bed. So yeah, certainly enjoyed a good day and afternoon there. And even yesterday, really good weather again. And we had our first and only preseason football match before football season starts in a few weeks' time. And that went well too, and good to get some time on the leg. So yeah, mate, feeling pretty good about things, and maybe even a touch of sunburn, even though I sunscreened up. So that just tells you exactly how good it was here in Welly. So, but no, we'll leave it at that, mate.
Sweet, nice one. Yeah, sounds like the weather's a good theme across the country.
Yep, oh, exactly. And a bit of a pity I couldn't get to the cricket yesterday because it did look nice down there. Although, as you and I spoke about before we hit record today, sometimes you just wonder how much better it would have been if it was at the Basin rather than the stadium. I don't know what the crowd was like, but you know, bit of sun at the Basin on a Sunday afternoon would have been prime way to spend your time. But you know, the stadium it is, and also the result didn't go well either, so we can probably be a little bit more grumpy about things.
Yeah, for sure. Yeah, it was looking okay up until the last bit when it didn't look okay. But yeah, that's sport.
Almost like old school Black Caps, just a bit of a capitulation in those middle orders and those middle overs, but is what it is.
Yep.
No, all good, mate. I will close us out there, but thanks as per usual for your insights. You know, with the conflict in Iran, I think every week we're going to be leaning on you for how the Reserve Bank's going to be taking on this one. So I appreciate all your thoughts there. So I just want to say thanks again for listening. Please do get in touch with any questions or feedback. Please do go and chuck a 5-star review, hopefully, on the podcast player you're listening through right now, and feel free to chuck a comment or a question on there as well. We do read all of those, as I said earlier. So that's all for today. My name is Nick. He's Kelvin. You've been listening to New Zealand Property Market Podcast. Mā te wā.